Hello, hello, hello. It's Toria Howard, a real estate educator, here to educate you. Back once again, talking to homeowners, well, first-time home buyers who are looking to be homeowners, and what to do 90 days before buying a home. I know we're into February, with the end of February, and there's a lot going on in all types of sectors, but let's focus. Let's block out the distractions and focus on you and what you can do in these next 90 days to get prepared for the busy buying season coming up in the spring. So typically, you'll see more homes on the market during the spring, typically, depending on where you live, between May and starting in May, but some as soon as April, when the weather starts, warming up and things of that nature. So we can say April, May, up into the June, July, up in there, you'll see more homes on the market. So it's time now. You still have time to, get yourself together so that you'll be prepared. So if you're serious about buying a home this year, what you do in the next 90 days will determine whether you feel stressful or strategic. So that's where you want to have a strategy and not feel stressed. So buying doesn't start with the touring of homes. It starts long before that. I've seen buyers rush into showings, fall in love, and then scramble financially. That's not what you want to do. Excuse me. I've seen buyers position themselves for 90 days, excuse me, walking calm, confident, and competitive. You don't want to do anything out of desperation, and you don't want to get to a point where you fall in love with a home and you don't qualify because your finances are not in order. So we have to take these steps. So let's talk about what those 90 days should actually look like, right? So why 90-day change is everything. So at this point, you're going to look at your credit score update monthly. So you're going to be looking at that every 30 to 45 days, your credit score updates. So you need to be doing that part and making sure that you're monitoring that with the credit reporting agencies. Now, you should be looking at your FICO scores. Credit Karma, some of these other sites are giving you your Vantage scores. You want your FICO scores. So you need to be going to actual sites. You can go to Experian. Experian give you all three, or you can go to each individual one, but you can go to, Free Score Now. You can go to, what's some of Credit Strong. You can go to Ultra Score. You could go to, it's so many different sites that you can go out there and get your FICO score. So it's up to you. And even if you got it through your bank, sometimes I know Chase gives you all three as well. You can do your bank. If you bank with Capital One, they give you all three as well. So you need to be looking at that, updating that, doing some things there, looking at your credit report. Your debt to income improves quickly. So you want to make sure you're paying down those credit cards. And if you don't have a strategy, you can use the avalanche method where you take the highest interest or the highest balance and you dump all of your money there. And then you just make sure that you're paying a little bit over the minimum payment on the other ones, maybe $10 or whatever. And then once you finish with that one, you just take that payment because you're not missing it. You take that payment and then you pay um, the next highest one and you go down from there and you'll be able to pay it off quicker. Or if you're, not as bold, you can go with the snowball method where you start with the smallest one and work your way up and do the same thing. You put, majority of the money, you know, that you can there, and then paying the minimum, and then you just snowball that payment up. Because if you want to go smaller, you want to make sure that the smallest payment gets, paid first, and the second and third. So then it can get, once you get to the point where you're not missing the money, once you get to the highest one, you have a large amount that you can dump on there. And then savings builds leverage. So you want to make sure that you have a substantial amount of, I don't want to say a substantial amount, but at least say, for instance, if you know your numbers, to go back and look at some of my other videos, knowing your numbers, knowing what you can afford. You can use all types of platforms. You can even use Google. You can Google, like, if I make, such and such $100,000 a year, 90,000, $60,000 a year, what could I be possibly be pre-approved for in a mortgage with a credit score of da da da. And it will it will spit you out, and you can ask like, ChatGPT, all these other different platforms that you can use, but you can also ask like, what's my monthly payment, because you got to put the city and state in there because they're to factor in the taxes and all of that. You also can go to realtor.com. Realtor.com, you can go and look at actual homes, and then you can scroll down and they have it where you can put in, different numbers, and it'll give you how much that home, approximately how much you would be paying, with a 3.5% or 1% down or 3% down, because you don't have to put 20% down. Now, when it comes to your savings, a lot of you are getting tax refunds. I'm not, but a lot of you are getting tax refunds. So take a substantial amount of your tax refunds and put it towards your savings instead of going out and buying frivolous things that you don't need, that's not going to break or not work, or you pay a high interest on. Take that money and put it in a high yielding savings account, so that's where you're going to hold your 1% of your maintenance fund as well. So put that there and then keep it there until you're ready. And a lot of times when you have these different programs and when you have grants and the different things to help you buy a house, you might not even touch that much. You might use it for your inspection, your appraisal, but not for a down payment. So if you're getting a substantial amount of money for your tax refund, I will take majority of that money and save it, and then take some the other and pay down some debt. That will help your debt to income ratio and savings at the same time. So, and then lenders evaluate your patterns. They're gonna see how you're spending in your bank account. They're gonna want to see your bank account, so they want to see how you're spending. What your balances are. If they don't like you know, the for by pay methods, the Klarnas, the Afterpays. They don't like that because it makes it seem like you're buying things that you don't have the money for. So you need to make sure that you are minimizing that or getting rid of those in these 90 days as well. So if you reduce one credit card balance by 2,060 days, your DTI shifts and your rate options improve. And so that's what you're looking for. You want your rate to be as low as possible. You have rates under 6% right now in certain banks. So that's what you're looking to do. You want to get the lowest possible rate. You don't need 3 years. You need 90 days to make a change. Anytime you are doing anything, you see the results in 90 days, from workouts to eating right to, learning something new. If you focus 90 days, you will see the results. So the 5 things to fix in the 90 days. That's the next thing that I want to talk about. So know your comfortable number. I kind of mentioned that a little bit earlier. So not Zillow, not what the lender says. You want to know how much you can afford every month, and that is including your principal, interest, taxes, insurance, PITI. But let's not forget the utilities, and your M for your maintenance fund. You need 1% of your home value or sales price in a year in a high yielding savings account. So for instance, if your home and you bought it for 2,000, 200,000, then that means you need $2,000 saved every year. It's by the year, y'all. Take $2,000 and divide it by 12. It's such a small amount. And all you're doing is taking that money directly from you and putting it over into the high yielding savings. I would have it direct deposited if you think you're not, you know, uh, disciplined enough. So an example would be, just because you're approved for 375,000 doesn't mean that you spend the whole 375,000. Know exactly what your numbers are. If you know, okay, I only want to spend, this is what you're talking about. If you know that a lot of people only calculate the mortgage part of it, the principal and the interest. Okay. You need to know the taxes, insurance, numbers, kind of guesstimate those. You're not really don't know because you don't know. But you need to say, okay, $2,000 a month is my, that's my top. That's all, but that's got to include utilities, and your maintenance fund. If $1,800 is it, the 15, whatever that is, you need to make sure that you know that number. So if your car breaks down, can you breathe financially? And that's what you don't want to be house poor, where you're spending all your money on your home and you don't have anything for the life stuff that could happen. Car breaking down, children need stuff. Children are a bill. They have activities they want to do, they have things that they want, to accomplish. So you need to make sure that you're not, you know, taking away your lifestyle when it comes to buying a home. Know your numbers. So that one of the things that you need to do is clean up your credit strategically. Don't open any new lines, don't make any big purchases, reduce revolving balances, and those are your credit cards. Like your installments, is good for the mix, but they don't really affect you more than the revolving because the revolving is 30% of your credit score. So you need to understand that 35% is the history, 30% is the the revolving account. So you want to make sure that you get those down as much as possible. You want to get that to 6 to 7%, okay? Or lower. But you have to spend on your credit cards because if you don't use it, you're gonna lose it, as I always say in the gym, about my dad, is his saying. But you need to make sure that you are still using them, but only using it for things you already have the money for. So you're only going to use it for gas, groceries, cell phone bills, stuff. You're going to pay your bills with your credit card at this point and then pay it right back off as you have the money. So the next thing you need to do is practice the payments. Start paying the future mortgage now. So if your rent is 1,500 and your future payment is 2,200, start setting aside $700 monthly. Why? Test your comfort. It builds reserves. It creates discipline. You want to be able to have all of these things in place because it takes discipline to be able to use your home to build wealth. So, and then you want to build a buffer. So you have closing costs, you have moving expenses, and you have your maintenance fund. So that's why I said those of you that are getting a larger lump sum or a lump sum from your tax returns, this would be a good time to have that buffer. Use that tax return money to use for a buffer. Don't go out and buy the lemon car. Don't go out and, or if you want to at this point when you know that your credit is not the best, invest in vetted credit repair. I do credit repair. Not me, but I have a company that I'm affiliated with that does credit repair. But I know credit repair people who will get the job done because they've helped me. Okay. So, and my services have helped me. So I know I'm saying the tried and true, but invest some of that money in your credit fix if you can't do it on your own because it takes a lot. Making up the letters, you know, keeping track of all those things, give it to somebody else. So you want to make sure that you're building a buffer because you want the closing costs, the moving expenses, because you're gonna have to buy boxes and hire movers. If you got your cousins and them that can help you, that's awesome. But a lot of people, when you get a particular age, you don't have those same people to help you move. So you need to have, moving expenses, know how much those cost, your maintenance costs, knowing that you have to have 1% of your sales price at this point. So you want to have a buffer because water heater breaks week 2. What's your move? Guess what though? You should have a home warranty. So that home warranty is a part of your mortgage and put that as part of your expense. So you have your principal, interest, taxes, and insurance, your utilities, your maintenance fund, but you also got to factor in your insurance. Okay. You want to have that, alternative insurance so that you can make sure that you are covering these things if that happens in your home. Homeowners insurance doesn't really cover things that is not a natural disaster or just a whole disaster as a whole, like a fire, flood, stuff like that. Now you gotta make sure you have the best coverage for that because sometimes it won't be covered. So you gotta make sure you're reading your insurance. You gotta have some places gotta need flood insurance that's separate outside of homeowners insurance. So know all of these things and make sure that you are having that extra insurance, so alternative insurance that's going to, the home warranty is what I'm talking about, the home warranty for, those things that break like that in the next 2 weeks. And also get back with your real estate agent because you might be able to, I didn't do this. I should have got back with my real estate agent when my house flooded and it was like $30,000 in damage. But he told me like, why didn't I come to him? And I didn't even think to come to him, but go back to your real estate agent and see if they can get back something from the seller. Okay. So the next thing you want to do is strategic pre-approval. So it's not just I got approved, but I understand my numbers. So when you go to the lender, you should already know what you're looking to spend. It doesn't matter what number they give you. Already know what you want to spend. So this is something that buyers usually skip. Emotions, impatience, comparison, fear of missing out. Emotions rushes you. Strategy positions you. Don't act out of desperation. And that was one of the things that I did a lot of times when I made a lot of sacrifices that I didn't need because I let my emotions get involved. I let the distractions come in play, and I acted impulsively and did things in an impatient manner. And I paid a heavy price tag for it, like selling my home at a short sale when I didn't have to, and fumbling $200,000 almost. So make sure that you understand and don't act on the emotions. So with that being said, if you position correctly, you move differently. So comment 90 days. Like, comment, subscribe. Please share this with anybody you feel that needs this information. Book your Pathway to Keys consultation. That link will be in the description. And I also have ebooks. So I have first time homebuyer ebook called Journey to Your Castle, where I take first time homebuyers from concept to mindset because your mindset has to change, goal setting all the way to the closing table. Then I have one for House Rich and Money Smart, how to turn your home into a wealth building powerhouse. Okay, how to turn your home into a wealth building powerhouse, showing homeowners how to turn their liability into an asset. And that's what you want to do. That's what you need to do. Learn how to leverage your own home to build wealth for you and your family. And keep an eye out on my upcoming book called Keys to Your Castle, which is going to be a blend of all of those things together in a workbook style where you'll be able to map out every single thing step by step. It's not your average, real estate book. This is going to be something astronomical. So I'll be launching that sometime in March. Pre-sales will be going up pretty soon. So definitely comment 90 days if you are looking to get your 90-day run in. So have an amazing day. Make sure you like and subscribe. I put it together. Like and subscribe. Have an amazing day.